A retired public school teacher in Ohio owns the firm employing a billionaire hedge fund manager. We track the 6 levels of wealth from your first $100 to the family office boardroom and expose the individuals controlling the capital behind the velvet rope. On a Tuesday evening, you invest $100 through a mobile trading app. Your roommate Danny buys into the same index fund that same evening. 3 full decades pass before you approve a $2 billion transfer for anonymous clients. Danny touches nothing but his own personal checking cash. That initial $100 deposit looks insignificant on your phone screen. The bank attaches a transaction fee to it, and the charge looks trivial by comparison. The app designers launch a financial wealth system using that tiny transaction charge. The programmers hide the core rule from your phone display. Your boss grants you larger client portfolios to direct with each career promotion while shrinking your take-home profit margin. That specific $100 bill remains the only pure capital you own. The corporate brokers claim their first hidden percentage the exact moment you hit the confirm button. That hidden percentage shows up the second your $100 hits the market. You are 22 years old. Your phone holds a brokerage app you downloaded in 4 minutes flat after answering almost zero questions. The app costs nothing to use, and that free price tag is the first misconception you carry into investing. You tap buy on a single ticker tied to a broad index fund holding 500 of the biggest American companies. That basket has averaged roughly 10% annual returns over long stretches of time. The fund skims 0.03% from your holdings each year. On $100, the fee amounts to 3 cents. The fee structure keeps the number invisible at your current balance, and at your current balance, 3 cents might as well be zero. Danny purchases the identical share on the identical app that same evening. You swap screenshots over text. Both of you feel a strange mix of grown-up responsibility and mild recklessness, like you crossed some threshold into serious financial life without anyone checking your credentials. The price you paid and the price you could sell for right now are two different figures. That gap has a name, the spread. No line item on your monthly statement mentions it. A market maker on the opposite side of your order pocketed a fraction of a penny, and that market maker collected fractions of pennies across millions of identical orders throughout the trading day, every trading day. You never signed a document authorizing the charge. Your account paid it either way. You learn the word compounding and watch it produce results far slower than you expected. $100 growing at 10% produces $10 over 12 months. You expected liftoff and received a rounding error. Most investors abandon the process at this exact stage, the stage where the arithmetic bores them and the dollar amounts stay tiny. That boredom marks the easiest window to begin, and most people walk right past it. You stick around. You program the app to purchase a small amount each week on autopilot and close the screen. Laziness drove that decision, and it will stand as the sharpest financial move you make over the next 10 years. 8 months later, the market drops 19% in one continuous slide. Your balance now sits below the total cash you deposited. Danny liquidates his entire position on a Tuesday afternoon, converting his shares back to cash in a single session. You face a choice that same night about whether you can stare at a shrinking number and leave your hands in your pockets. Level 2 begins with that choice. You leave your hands in your pockets. You keep the weekly auto buys running while the balance glows red, a move that feels irrational and happens to contain the whole playbook. You turn 29. The automatic purchases never paused and the crashes never stopped either. One sell-off erased a third of the market in roughly 5 weeks and then returned every point within 12 months. You internalize the lesson that the crash and the rebound belong to the same cycle, and the investors who lose money are the ones who flinch at the worst possible moment. Your account crosses $100,000 after 7 years of contributions. The first $50,000 accumulated at a crawl. The second $50,000 arrived faster because the market's 10% return now compounds on a meaningful base, generating $10,000 a year in growth while you sleep. Charlie Munger called the first 100,000 the hardest money anyone will ever earn and urged people to reach it as fast as possible through any available method. You understand his urgency now. You feel the machine switch from dragging to pulling. You hold a specific kind of wealth that nobody will describe to you for another decade. Every dollar in the account belongs to you without condition. No client can demand it back. No lockup period traps it. No partner questions your decisions during a drawdown. You could liquidate the entire position on a random Tuesday, purchase a boat, and answer to nobody but yourself. You start reading about tax-advantaged retirement accounts and discover the government has offered you a discount you ignored for years. You begin to see wealth as a structure you build, separate from the number on the screen. Most people skip the structural work because they stay fixated on the scoreboard. Danny re-entered the market 2 years after his panic sale, buying near the top after missing the full recovery. He tells you he wants a better entry point. He has repeated that sentence for 6 years. A new form appears inside your brokerage app. It asks for your net worth and your annual income. The platform is determining which investments the law permits you to access. The most lucrative opportunities in the country sit behind a velvet rope, and the threshold for that rope was written into regulation before you were born. That hidden percentage follows you straight into level 1. You're 22. $100 sits in your checking account. Your phone holds a brokerage app you downloaded and verified in roughly 4 minutes. It asked you almost nothing. Free to open, free to use. That free label is the first lie you swallow without chewing. You tap buy on one share of a broad index fund, one ticker, 500 of the biggest companies in the country bundled inside it. Over decades, that basket has handed back around 10% per year. The fund skims 0.03% for the privilege of holding your money. On $100, you owe them 3 cents annually. They engineered that number to register as zero in your brain. At this size, your brain is right. Danny opens the same app that same night, buys the identical ticker, you swap screenshots over text. Both of you feel like you pulled off something grown-up and a little reckless. Neither of you notices the gap. The price you paid to buy and the price you'd receive to sell are two different numbers. That sliver between them goes by the name spread. No invoice prints, no line item appears. A market maker on the opposite side of your order pocketed a fraction of a penny. They repeat that fraction across millions of identical trades every trading day, year after year. You never agreed to it in writing, you paid it anyway. Compounding teaches you its first lesson through disappointment. $100 compounding at 10% produces $10 after 12 months. You expected a rocket. You got $10 in a rounding error. Most 22-year-olds close the app right here in the exact stretch where the math bores them and the balance embarrasses them. That boredom is the only window where starting costs you nothing. You keep the app open. You schedule a small automatic buy every week. You stop checking the balance. You did the smartest financial move of your next 10 years, and you did it because checking felt like too much effort. 8 months later, stocks shed 19% in one continuous slide. Your account now shows less than you deposited. Danny liquidates his entire position on a Tuesday afternoon. You stare at your phone that night and decide whether you can watch your own money evaporate and keep your finger off the sell button. Level 2, the first 100,000. You keep your finger off the button. You keep buying while the number glows red. The whole thing feels deranged. It also happens to be the single mechanic that separates the people who build wealth from the people who watch it happen to someone else. You're 29. The weekly auto buys never paused. The crashes never paused either. You sat through one that erased a third of the market in roughly 5 weeks, then returned every lost point before the calendar flipped. The crash and the bounce back are one continuous motion. The only investors who take permanent damage are the ones who blinked during the ugly half. 7 years, that's the full stretch the account needed to cross $100,000. The first 50,000 inched forward like you were pulling a sled through mud. The second 50 arrived faster because 10% of a bigger pile throws off 10 grand a year while you sleep. Charlie Munger called the first 100,000 the hardest money a person will ever accumulate and told people to claw through it as fast as possible by any legal method. You finally understand why he said that. You can feel the machine yank forward under its own power, instead of you dragging it by hand. You are the richest you will ever be in one narrow way that nobody bothers to mention for another 10 years. Every single dollar in that account belongs to you. No client money mixed in. No lockup period. No phone call to a board when the number dips. You could dump the whole position on a random Tuesday, walk into a marina, and buy a boat. The only person owed an explanation is you. You start reading. You open a retirement account that carries a tax break and realize the government parked a discount in front of you years ago. You never picked it up. You start grasping that wealth functions as architecture. Most people fixate on the balance and never pour the foundation. Danny sold at the bottom 8 months in. He climbed back in 2 years later, close to the peak, after sitting out the entire recovery. He tells you he's waiting for a better entry point. 6 years of waiting so far. Then a form pops up inside the brokerage app, a question you've never encountered. It asks for your net worth and your annual income. The platform is sorting you into a legal category right now, deciding which investments you're permitted to see. The top-tier opportunities in this country sit behind a velvet rope. A committee drew that rope using a number they fixed before you were born. You step over that red velvet rope around age 35. The government sets a specific financial threshold for this transition. You prompt the state to reclassify your financial status by reaching a net worth of $1 million in liquid assets, excluding your primary residence, or an annual income surpassing $200,000. The authorities label you an accredited investor. This legal designation means the state trusts you to risk your hard-earned capital in private markets. You gain access to investments hidden from standard retail trading platforms. Private technology companies allow you to buy shares before they launch an initial public offering. Syndicators you met at a conference organize real estate projects for your cash. Managers of private funds withhold daily share prices. You write a large $40,000 check for your first private investment and experience a quiet, uneventful transaction. You see no flashy confirmation screen and no live portfolio ticker. The deal requires a bank wire, a signed legal contract, and 3 years of complete radio silence. You face a sudden unexpected expense and learn the true, painful meaning of illiquidity when you seek those funds. You find the capital inaccessible. The contract contains those strict restrictions. That locked capital acts as your mandatory entry fee to this exclusive tier. That same restriction generates a large portion of the investment profits. You avoid panic selling during market downturns because you cannot access those assets. You become a limited partner in their vehicle by writing a check to an established investment fund. A seasoned professional manager receives your capital and multiplies it for a fee. You read the dense partnership agreement and find 2 specific fee structures that will define your entire career in finance. The manager collects an annual management fee independent of the fund's actual performance. The manager claims a large percentage of the profits when the investments succeed. You learn the fundamental economics of the asset management industry from the client's perspective. You watch your invested capital grow and compound. Wealthy people notice your success and talk about your growing portfolio during private dinners. A close friend who tracked your financial progress for 10 long years asks you to manage his capital. You make a polite, measured request for time to consider the offer. Your mind holds a firm decision. You trigger a massive legal shift and alter the ownership status of the money sitting across the table from you when you say yes. You step into level 4, the crossover, by saying that single word. You leave behind the invisible boundary separating individuals who invest personal savings from professionals managing outside capital. You experience a transformed daily reality, stripping away the familiar feeling of managing your initial $100. Friends cannot hand you cash to purchase equities. The government assigns you a specific title the second you demand compensation for financial guidance. You become an investment advisor. Lawmakers branded you a fiduciary through the Investment Advisors Act of 1940. Congress requires you to prioritize client welfare above personal gain in every written agreement through this legislation. You pass the Series 65 examination and file official state registration documents. You hang a physical shingle declaring your capability to safeguard what regular people cannot afford to lose. You demand a 1% annual fee on the total capital you direct, without regard to stock market fluctuations. This percentage sounds small. You recognize this tiny percentage as the exact mathematical advantage index funds used against your first $100. You hold the knife in this reversed scenario. You generate an annual $10,000 by managing $1 million and executing a few trades. You collect $400,000 by controlling $40 million. You abandon market analysis to focus on accumulating assets. You receive pay based on total volume rather than accurate predictions. You rewire your fundamental understanding of wealth through this specific realization. Your clients own the $40 million sitting in your managed accounts. You lack permission to spend a single penny of that principal. Clients will file devastating lawsuits against you for severe financial mistakes, yet courts prevent you from claiming ownership of the underlying assets. You possess the management fee. You exchange direct ownership of a small bankroll for absolute control over a massive fortune. You secure the most lucrative deal of your career through this arrangement. You will lose sleep at 3 in the morning years down the road while thinking about this arrangement. Your firm expands. You grow your baseline from $40 million to $90 million. You face a second regulatory shift as your managed capital crosses the $100 million threshold. Federal regulators claim jurisdiction over your operations and strip authority from state officials. You hire a dedicated compliance officer and submit to rigorous financial audits. You operate a legitimate corporate entity. You lose interest in the standard 1% management fee. You demand a percentage of the actual investment profits. You want the exact performance bonus your previous fund managers kept for themselves. You discover the rule requiring clients to possess greater wealth than standard accredited investors to charge this performance fee. The government designates this ultra-wealthy demographic as qualified purchasers. You must establish a formal private fund to collect these profit shares. You must solicit capital from institutional allocators who evaluate your historical returns with cold mathematical precision to complete this final step. You reach level 5 and become a fund manager at age 41. You hire corporate attorneys to draft the partnership agreements. The legal bills for launching the operation exceed the price of your first car. Government regulators demand stacks of obscure paperwork. Opening day arrives. You manage capital for qualified purchasers. This specific tier demands $5 million in active investments. Simple net worth fails to qualify. Your backers include family offices, charitable foundations, and wealth advisors. These individuals evaluate your track record using strict mathematics. They have reviewed hundreds of similar pitches. They shut down the vast majority. Investors abandon the traditional fee structure of 2% annually plus 20% of the profits. Your new partners drive hard bargains. You agree to manage the capital for 1.5%. You take 15 to 20% of the gains. You collect that profit share above a high water mark. This rule forces you to recover every single dollar of previous losses before earning another performance bonus. Your investment approach generates strong returns during the first few months. $500 million flows into your accounts over 3 years. A portfolio manager at your tier collects a base salary of a few $100,000. Strong market performance pushes your total annual compensation into the multi-million-dollar range. You achieve a level of wealth that astounds ordinary people. Then the market turns against your highest conviction trade. The stock drops every week through the spring and summer. You calculate an 11% decline in your portfolio by late summer. Your institutional backers send polite emails that function as countdowns. You track your current asset value trailing the high watermark by a wide margin. You will work for years to climb back to the peak you established in January. You survive on your base salary. That fixed paycheck feels tiny after you experienced massive bonus payouts. A random Thursday brings bad news for your worst-performing asset. The company reports a massive supply chain failure. The shares plunge on unexpected news. The trading desk gives you 20 minutes to make a choice. You can sell the shares to lock in the large loss and admit your mistake to your investors. You can hold the position and risk losing more of their capital. You choose to hold the shares. Investors validate your thesis months down the line and the stock rebounds. You realize you lost a week of sleep stressing over capital you do not own. You notice your personal brokerage account remains untouched for 4 months. You spend all your energy managing outside wealth and ignore your own finances. Your fund recovers its previous peak. You learn a harsh lesson about the asset management industry. Managers close the majority of new funds before their 5th anniversary. The survivors spend their entire careers hunting for larger allocations to reach the institutional tier. The absolute largest allocations come from a tiny group of mega-allocators who ignore your phone calls. These institutions manage the retirement savings of millions of public workers. One of these giants agrees to a meeting. You sit across the table from them and understand their function. They distribute billions of dollars and they are interviewing you for the privilege of managing a small fraction of that capital. You accept the chief investment officer role at a massive public pension fund at age 51. This promotion moves you up from managing your own fund. Your daily routines exclude picking individual stocks. You now select the portfolio managers who pick the stocks. You hire investment firms and you terminate investment firms. Your most minor daily choices eclipse the single largest trade you ever executed at your previous firm. The specific public pension fund you manage holds hundreds of billions of dollars. The largest public pension in the country controls over $400 billion. Vast capital pools pay the retirement benefits for millions of teachers, firefighters, and clerks. Your name remains a mystery to these workers. The capital sitting on your desk belongs to everyday citizens. You guard a 40-year-old promise to these workers. You manage the exact same diversified portfolio structure that elite university endowments popularized decades ago. Investments span public markets, private equity, real estate, and external funds that professionals manage. These professionals mirror your former self. You occupy the identical seat across the table that you begged to sit in. One anxious portfolio manager flies into town to defend his specific investment mandate. Sweat soaks his dress shirt during the presentation. You recall feeling identical nervousness during your own pitching days. You base your final hiring decision on his raw performance metrics. Outside capital leaves no room for sentimentality. You transfer $2 billion from one investment firm to a competing firm during a morning meeting lasting less than 60 minutes. You execute the entire transaction inside a quiet boardroom. Team members issue a recommendation, board members cast a vote, and you sign the authorization paperwork. $2 billion shifts to a new manager while the air conditioning hums as the loudest noise in the boardroom. Management at the fired firm will terminate dozens of employees before Friday. You eat a normal lunch because you executed your fiduciary duty. Fiduciary duty requires you to act as the most detached and logical steward of outside capital in existence. Your compensation package climbs into the low millions following several consecutive years of strong investment returns. This salary represents a discount compared to the steep fees that the external managers charge. External managers reply to your emails within minutes. These professionals recognize that you control the actual spigot directing capital flows. You hold more influence controlling capital spigots than possessing personal fortunes. You stand at the peak of the finance hierarchy you began climbing at age 22 with a single $100 bill. Morning shifts move more capital than the total reserves of many sovereign nations. You direct billions of dollars. You possess a suburban house, a robust retirement savings account, and a personal brokerage account you have ignored for several months. One share of an index fund sits inside that ignored brokerage account. You purchased that specific share at age 22. You dedicated 3 decades to mastering the movement of vast financial oceans while ignoring the one small personal pond you own. A paper statement reaches a retired fourth-grade teacher every 3 months in a town you would never visit. She spent 31 years teaching fourth graders in public school classrooms. Her pension exists as one line item in the fund you steward. A slice of the $2 billion you moved that morning belongs to her in legal terms. She never learned your name once. You command the money while she holds ownership exceeding yours. People at the top possess smaller stakes than people at the bottom. You spent your entire career climbing toward the position where you hold the smallest share of it all. Danny skipped every velvet rope. He refused to register or raise a fund. He avoided meetings with stressed portfolio managers. He panic sold at the bottom years ago and abandoned his market timing schemes. He adopted the exact strategy a 22-year-old uses and set up an automatic monthly purchase into that same index fund for 30 years. He built an account worth a few $1 million and kept complete personal ownership. He answers to 0 clients and skips lockup periods. He ignores high water marks and fiduciary duties. He mails 0 statements to strangers claiming his assets. Danny can liquidate his position on a Tuesday to buy a boat. You surrendered that exact freedom to your career. Corporate executives hide a massive legal loophole from every ambitious employee climbing their ranks. At age 35, you step over the velvet rope to access exclusive private market investment deals. Lawmakers built this barrier using the $1 million net worth and $200,000 income thresholds to divide accredited investors from the general public. Legislators established those exact figures in 1982 and ignored mandatory inflation adjustments over the following decades. Less than 2% of American households cleared those strict financial requirements in 1983. 40 years of continuous price increases pushed 1 in 5 households past that identical statutory finish line in the modern economy. Politicians refused to lower the barrier to entry. Everyday consumers lost purchasing power, while legislators kept the legal threshold frozen in time. You spent decades striving to cross an exclusive boundary that economic tides washed away. You pushed other people's capital up a corporate hierarchy throughout your professional life. You surrendered personal equity for a larger management scope with every single promotion. Danny rejected that corporate climb. He remained grounded and maintained absolute control over his own assets. You both made logical choices. Only Danny possesses the ability to quit the rat race and walk away at a moment's notice. He steps out. Beyond the velvet rope, family office teams organize their money across multiple distinct tiers. Inheritors anchor the foundation while architects design the complete financial ecosystem.